This is going to be the only fair value gap video that you guys need to watch in order to fully understand fair value gaps, imbalances, and inverse fair value gaps. I'm going to be covering how to identify them, how to use them on a chart, and also when we can use them to actually take trades off of them. Obviously, we need a lot of other confluences to actually take these trades, but this is mainly just going to be going over imbalance as a whole, which is fair value gaps, imbalances, and inverse fair value gaps. So with that being said, let's jump on the chart. Let's talk about how to identify them, and then also make sure you guys stay to the end so that I can show you guys not only how to identify them, but how to actually place trades using this super great confluence that I pretty much use every single day in order to place trades. So let's pull up the chart. Before we even start doing anything with candlesticks or anything, we're gonna do a Picasso drawing. Okay, so a fair value gap, and something that I like to do is I like to help people fully understand the confluence. So we want to be able to not only be able to identify it, but know why we're using it in the first place. Because if we're just placing on a trade, just saying like, oh yeah, this happened, so I'm going to place a trade, there's not much confidence in that. Me personally, I like to have like a crazy amount of confidence when I'm going into a trade. And in order for me to have a crazy amount of confidence going into a trade, I need to fully understand the confluence that I'm taking that trade off of, or else why the fuck would I be confident in it? I need to know why price is moving. So first, I'm going to show you guys how we can identify them. I'm going to give you guys a little drawing of it, and then we're going to go ahead and describe why price moves the way that it does off of these confluences, and then we'll go into identifying them. So a fair value gap is a 3 candlestick pattern. Okay, we have one candle, and then we have our expansion candle, and then we have another candle. So, as we know, anatomy of candlesticks, we have, boom, this candle opened right here. It had buy orders that pushed it up here, and then sell orders pushed price down here, and at one point in time, price came down here. At one point in time, price came up here. Sell orders ended up pushing price down and closing price out right here. Then following that, we see a boom, big move up. So this candlestick closes up here. Next, this candlestick opens right here at one point in time during this, let's say this is on the hourly, okay? So during this hour, price got up to this point, price had sell orders down to this point, and then buy orders push it back up, and then price ended up closing here. So this is a bullish fair value gap, or where even is the fair value gap in the first place? Well, we know that price had buy orders push it up here, and then what happened? Sell orders were right here and caused price to push down, okay? And ended up stopping it right here. Then on top of that, we had sell orders push price down, and then buy orders bought it back up here. So what do we know? Sell orders stop here, and sell orders stop here. So with that in mind, what do we know? Sell orders stopped here, and sell orders stopped here. So what is there a lack of within this gap? There's a lack of sell orders. So this is part of the reasoning behind this. When we have this gap between the top candlestick of the first candle and the bottom candlestick of the third candle, we can identify a price range where there's a lack of sell orders within the market, that if the market retraces into it and we see buy orders filled within that price range where there's a lack of sell orders, what can we assume about price? Price is more than likely going to proceed up, especially if we're within an uptrend. Okay, so that's a bullish fair value gap. Why is it a bullish fair value gap? Well, first of all, if we're in an uptrend and we see a price range where there's a lack of sell orders and price goes into the price range where there's a lack of sell orders, and we see candlesticks moving up out of that, confirming that buy orders have been filled, then we can safely assume that price is going to move higher from there. And on top of that, why do we call these imbalances? Why do we call fair value gaps imbalances in the first place? Because it's imbalanced price action. We know that there's a lack of sell orders within here. So what is going to cause price to balance itself out? Sell orders to push price down in here, fill in this lack of sell orders, and then from there we can get buy orders out of that, and that's going to cause price to move higher. And more often than not, we see these imbalances get filled in order to balance out price action. And I'm going to show you guys how you guys can identify order flow and how you guys can identify which fair value gaps are going to get filled and which ones are going to be filled more likely than others on the chart, okay? So I'm going to be explaining that later in the video, so make sure you guys stay along for this. Next one, we are going to be identifying a bearish fair value gap. Bullish means up, bearish means down for all the noobs, okay? So bearish fair value gap. We have, boom. And also keep in mind, these three candlestick patterns, the first candle and the third candle, it does not matter the color of them. We don't see color. We don't care if the candle is red, green, black, fucking Indian, okay? It doesn't matter. It really doesn't matter the colors of these candlesticks. The only color that matters, the only discrimination that we do is on the middle one, okay? So this one can be an Indian candlestick. It doesn't matter, okay? It can be up, down, all around, okay? As long as this one is going down, and as long as we make a gap within, this is for bearish, the bottom wick of the first candle and the top wick of the third candle, then what do we know about this price range right here? It's imbalance. Why? Because there's a lack of now buy orders within here. So if price wants to come in and fill in this price range to balance out that price action, to come into the imbalance price action where there's a lack of buy orders and then we see sell orders come out of that, what is price more likely going to do? It's probably going to continue down from there. Okay, so that is our 3 candlestick pattern. Okay, we know that there's a lack of sell orders within a bullish fair value gap. We know that there's a lack of buy orders within a bearish fair value gap. Cool, 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 cool. Again, we don't care about the colors of the first candlestick or the third candlestick. The only one that we care about is the middle candlestick, whether it's going up or whether it's going down. Now, that's how we identify what a fair value gap is. What happens when we're trying to identify if there isn't a fair value gap? Well, it's super simple. If the wicks of the first candlestick and the third candlestick overlap, then we know there's not an imbalance there. So let's say this candlestick's got a huge wick up and this candlestick's got a huge wick down. Is there an imbalance within here? No, even though this candlestick is freaking huge, there's no imbalance within here. Why? Because we know that sell orders stopped all the way up here. Buy orders pushed it up and then sell orders were able to come in up here and push price down. Same thing here. On this third candlestick, sell orders came down here. So these sell orders are overlapping and now there's not a imbalance and there's not a price range where there's a lack of sell orders. So in turn, there's no imbalance. Same thing here on this bearish fair value gap. If we have buy orders, sell orders push us down, buy orders buy it back up, buy orders push price up. If we see something like this, there's no imbalance. There's no price range where there's a lack of buy orders. So in turn, this is not a bearish fair value gap. If the wicks of the first candle and the third candle are overlapping, there's no fair value gap. They're like, just think of the name. It's a gap. We can see the gap. Boom, it's right here, gaping hole. We want to plunge it. Okay, so now that we know how to identify fair value gaps, let's go ahead and look at them on the chart. This is something that I need you guys to understand. Don't just watch up to this point in the video and be like, boom, TJR taught me how to do a fair value gap. I'm gonna place a buy every time it comes into this fair value gap and I'm gonna be a quadrillionaire. No, Timmy, you're actually going to be retarded and homeless if you do that. Okay, we need to use a lot more confluences combined with this in order to be good at trading, okay? So this is just one of the confluences, and later down the line, maybe in like a week or so, I'm going to make a full YouTube video going over my whole strategy on how I look to take trades, and it's going to be like fucking 3 to 4 hours long going over all of this shit. But we need to understand that we can't just be buying and selling every single time we come into a bullish or bearish fair value gap. We need a lot more confluences with that. We need daily bias. We need liquidity sweeps. We need inverse fair value gaps. We need break of structure. We need order blocks, breaker blocks, all that good shit. Okay, but this is just one piece of the puzzle. So with that being said, let's go ahead and identify it on the chart. Now, like I said, there's a whole bunch of these things and they're all over the chart. So instantly, we need to be like a fucking tracker jacker. We need to be able to have aimbot, okay? When I get on the chart instantly, what am I seeing? I'm seeing boom, bearish fair value gap, boom, bearish fair value gap. Okay, and then within here, what do we have? Boom, bullish fair value gap. And then boom. Okay, this is something that I need to explain to you. Let me get rid of all these other fair value gaps. Sorry, I'm going a little bit too fast, but that just shows how good I am at trading. Okay, something I want you guys to understand. This is probably the best analogy that I have ever made in trading ever. Fair value gaps are like dicks. Size does not matter. We can have the girthiest, longest, biggest fair value gap in the world, and price will probably want it. You know, at the end of the day, it's a big one. We probably want that one, right? It's a big imbalance. We want it. But also, a little guy, a 2-incher, even a micro peen, it can do the job. As long as we get in there, we're making shit shake. And we gotta think from the woman's perspective. A penis is just one piece of the puzzle. A penis is just one adaptation to the full romantic embodiment of a man. So we need to be thinking about not just the penis, but we need to be thinking about what lies within the personality. And that's the second piece of it. What lies within a fair value gap? An imbalance. What lies within a man? Personality. So they're seeking not penises, they're seeking and yearning for human connection. They're yearning for a personality that they can bond with. And it's the same thing with fair value gaps. When we get onto the chart, we know that the chart, it's not just seeking and looking for the biggest dick out there. It's looking for that imbalance. That's all it wants. It just wants a connection. So if we see a little guy versus a big guy, we're not discriminating. Both of them can be filled. They're both valid. Why? Because it's what lies within. It's that personality. It's that imbalance. Size does not matter, okay? So with that being said, let's pull up this example here. So let's look at this. This little guy right here, this is an imbalance. Why? You guys are probably saying, TJR, you're so dumb, bro. We want the big daddy. We want Drake. This is Drake, okay? We want Drake. Well, bro, what about little Timmy? What about TJR? This little guy can do the trick too. And we can see he did the trick. This imbalance got filled and we saw a bullish reaction off of it. Like, then again, Drake comes and just leaves a gaping hole in that bitch. But okay, wow, we're getting off track here. Wait, I'm getting distracted. But you guys get the point. Size doesn't matter. Even if it's the littlest fair value gap, it still matters. Okay, so this is a good example of a bullish fair value gap. Where's our 3 candlestick pattern? We have our first candlestick. Where's the top wick? Right here. Third candlestick, move up. Again, the color, we don't see color. Okay, the third candlestick's wick is right here. These two wicks don't overlap. We leave a bullish fair value gap right here. Price comes in, fills the bullish fair value gap, and then we get a bullish reaction out of it. Obviously, if we had went long off of this, like Drake's coming through and swinging his shit on top of our forehead. But again, that's why we need several other confluences. All we want to do right now is just to be able to identify them. So again, where's our fair value gap? First candle, second candle, third candle. These wicks, they don't overlap. This is a bearish fair value gap. First candle, second candle, third candle. This third candle doesn't even have a wick, but it's still considered as a fair value gap. Boom. First candle, boom. This is a bearish fair value gap. Let's show an example of what a fair value gap is not. Okay, let's see price right here. We have first candle, second candle, third candle. What do we see? The top wick of the first candle, the bottom wick of the third candle. These two wicks are overlapping. This is not a fair value gap. Okay, it's pretty simple. Like, we literally just see the gaps on the chart and it's like, bet, fair value gap. Bet. Is this a fair value gap right here? No, these wicks, they overlap. First wick, third wick, overlaps. Is this a fair value gap right here? No, first wick, third wick, overlaps. Is this a fair value gap right here? Yes, first wick, third wick, doesn't overlap. It's a fair value gap. But as we can see, without context, these things kind of fucking suck. Again, getting dick down, okay, we might have to move off from this, but last analogy. Getting dick down without any personality or human interaction, you're pretty much just like, you're begging for an STD. You're begging for a stop loss. Okay, and that's pretty much what you're going to get if you're not seeking and understanding that there's more to an imbalance, all right? So now that we identified how to identify fair value gaps, it's pretty simple. We talked about how we can identify these. Let's talk about when we can use these and when they are best used. So if you guys have seen that my previous videos on liquidity, you guys are going to need to know what a liquidity sweep is. So if you guys haven't seen those videos, I highly recommend after this video, because I want to make sure you guys aren't just jumping from idea to go watch that so you guys can have this in your back pocket. So the first thing that we need to be able to identify and help us to be able to use fair value gaps is understanding where the liquidity sweep is and where price is going, okay? I haven't really made a full video on how to understand daily bias. I should, and I will eventually. There's a lot of trading videos that I need to make going into 2025. But essentially, if we can see a liquidity sweep and then a break of structure, the main thing that we want to identify is order flow. So super easy. If we can just see that we are in an uptrend, awesome. We know that this is bullish order flow. If we can see that we're in a downtrend, awesome. Then we can see that that is bearish order flow. And more often than not, the earlier we are into bullish or bearish order flow, the higher confluence and the more trust I have in fair value gap. So if we see a liquidity sweep and then boom, we start forming bullish order flow and like we're within the second like retracement, that's super solid. Like, okay, cool, I'll be looking for a fair value gap for price to fill and then boom, we can take trades off of that. However, if we're like all the way up here and it's like, all right, bro, we've made 1, 2, 3, 4, 5, 6, 7 freaking retracements at this point, we probably shouldn't be looking to enter into longs there. One, because price is already overextended, but also we've probably already seeked out all of the other draws on liquidity that price was looking to take out within that bullish order flow in the first place. Same thing with bearish order flow. Boom, if we sweep out liquidity, the first retracement is always going to be ideal if we can find a fair value gap within there, especially if we break structure or get an inverse fair value gap, which I'm going to talk to you guys about a little bit later in this video. If we can get a liquidity sweep, break of structure, then get a fair value gap to get filled, oh my, like boom, we're going absolutely berserk, okay? And then we're looking to enter off of that. And then second retracement, awesome, still cranking my shit, okay? Third retracement, okay, maybe a slow stroke if we haven't taken out our full take profit yet, maybe, you know, maybe we get a little bust, but you know, we're not trying to go too crazy. If we've already taken out our full take profit, there's no reason to even jork our shit, okay? Because full take profit has been hit, our bias has been completed for the day. Okay, cool, so now let's show this. I know that sounded crazy, but let's show this as an example within market open. And as you guys know, most like my strategy is pretty simple. And if you guys want to learn how I actually put everything together, and if you guys want to get coached by me, I have a full mentorship where I go over literally every single confluence that I have ever talked about and shit that I haven't talked about on YouTube, talking about order flow, talking about liquidity sweeps, talking about daily buys, talking about fair value gaps, talking about inverse fair value gaps, talking about breaker blocks, equilibrium, order blocks, all of that stuff. And there's a link in the description for you guys to sign up to that. If you guys want to learn more from me, be mentored by me for literally like get on coaching calls with me and for me to be able to actually walk you step by step through this stuff. Unfortunately, on YouTube videos, I can just get a brief little understanding of what you guys may need, but within the mentorship, it's like you guys can literally tell me like, help, I don't understand this, and then I can come in and I can fix it straight away. So if you guys want to sign up to that or have the potential, because this is an application process, okay, not everybody's going to be allowed to get in because we only want to take real people that are actually trying to do this. There's going to be a link in the description. So let's go ahead and talk about how we can actually start applying this. So let's go into yesterday's price action wasn't the best. Let's look at Thursday's price action. See if Thursday had a good fair value gap setup. So, oh yes, no, Thursday did have a perfect fair value gap setup. So I'm not going to walk through like the full strategy. The main thing that we want to look for is fair value gaps here. And then after this, I'm going to be talking about inverse fair value gaps. So to keep it short, we're going to speed run through the majority of my strategy. Okay, market opens, liquidity sweep, following that, break of structure right here. What do we see following the break of structure? Okay, so we know if we get a liquidity sweep to the upside, we're going to be looking for shorts to the downside. And we get a break of structure. So what, like we got two of our steps in. We see a liquidity sweep and then a break of bullish order flow into bearish order flow. So that should be ringing in our heads like, holy shit, we should get ready to look for a dick. Ooh, 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 ooh. Holy shit, we should get ready to look for a dick. Ready? We're looking for Drake's shit on the chart, okay? Because if we see a liquidity sweep, break of structure, we're looking for dicks, okay? And what do we have? Boom, Drake is all over the chart. We have one bearish fair value gap here. We have another bearish fair value gap here. Okay, again, we take it from the first wick's bottom candle down to the third wick's top candle, or sorry, the first candle's bottom wick to the third candle's top wick when it's a bearish fair value gap. Okay, then we have another one right here. What do we see price do? It comes in, it fills that imbalance, and then we see selling pressure out of it, and then what do we see price do? Boom, royal fucking rumble to the downside. And then price ends up going to seek out whatever, a bunch of different draws on liquidity. Like right here. Come on, bro. Whatever. My magnet's tweaking. but price ends up going all the way down to hit like literally a 1 to 2.8 risk reward ratio. Okay, perfect example. We also have had a perfect example of that on Thursday on ES. So let's talk about that one as well. And then we'll find a bullish example for fair value gaps as well. So again, similar situation, market opens, liquidity sweep, break of structure. What are we doing? We're looking for Drake. Okay, we have this small one. Again, the little ones matter too. We have this small bearish fair value gap right here. Then we have this bearish fair value gap right here. What do we see? Price comes in, fills the bearish fair value gap. Boom, we get a little sell-off, okay, short work, and then what does price do? It goes, seeks out, draws on liquidity down here, okay? And again, this is just talking about fair value gaps. There's a lot of other videos where I talk about how to set take profits, how to set stop losses, and I also talk about that in the mentorship and obviously help you guys learn how to put all of these pieces together. But today we're just talking about fair value gaps. But we can see liquidity sweep, break of structure. This is the first retracement after we start forming bearish order flow on that break of structure. This is a retrace confluence, okay? What I like to call fair value gaps are continuation confluences. Why? Because when we're within an uptrend, what are we looking for the trend to do? It's looking to continue. And how do we continue that trend? Typically by filling in fair value gaps. These are continuation confluences. When price retraces, more often than not, it's going to fill a fair value gap. So these are continuation confluences. Okay, now let's find a bullish example. Let's see if we can go back and let's look at Wednesday's price action. I think Wednesday was pretty bad price action. Oh, I think NASDAQ had a good bullish setup on Tuesday, if I remember correctly. NASDAQ, smoking on that gas pack. Oh wait, no, it wasn't a fair value gap. It was a order block. Okay, let's look at Monday. See if Monday had a good bullish example. I want you guys to be able to get to this level. Like, you see how I'm literally able to just scroll to the days that the shit happens on, and I'm able to instantly identify whether we have an example of that or not. Like, I want you guys to be soon to be at that level. This has got to be one. Hell yeah, there is one. Movie. Okay, bullish example right here. Look at this shit. Look at it. It's literally perfect. Okay. Hopefully you guys already see this. If you guys don't, it's okay. Daddy's going to hold your hand. Okay, what do we see? Liquidity sweep. Okay, liquidity sweep, break of structure. Then what are we looking for? Continuation confluence. Where's our fair value gap? Oh my God. Fair value gap, boom, gets filled. Bull run bitches to the upside. Okay, I literally took this trade on Wednesday. Liquidity sweep, break of structure, retrace into the fair value gap, boom, ripstick to the upside. They're easily going to be able to catch trades off of this. I would go to NASDAQ. I know it was the same exact setup. Let's try and find one more bullish setup. Let's see, Tuesday. Nope, Tuesday did not have anything. Let's go to Monday. Monday looks like there was high impact news. Yeah, if we don't have anything on here, then I'll just go straight into inverse fair value gaps. Okay, yeah, not worth it. Okay, cool. But anyways, you guys get how we're supposed to use these, okay? We're looking for 3 candlestick pattern. We're mainly going to be looking for liquidity sweep, break of structure, following that fair value gap. Pull out the sniper, take the fucking shot, bull run bitches, or bear cycle bitches. Okay, now let's talk about inverse fair value gaps. So inverse fair value gaps are different than fair value gaps because we're actually not really looking for these to get filled, and they give us like a different perspective on where price is going to go and what price is going to do. So what I like to say is fair value gaps are continuation confluences. Inverse fair value gaps are confirmation confluences and are equal to break of structure. Okay, so inverse fair value gaps in my eyes are equal to break of structure. Now, why is that? So the first thing that we need to do to understand inverse fair value gaps is understand fair value gaps. Luckily, we just talked about fair value gaps. We fully understand these now. What do we know about fair value gaps? Well, like I was saying, they are continuation confluences. So when fair value gaps get filled and then price moves up because of them, like that shows bullish order flow being maintained. And then the same thing to the downside. It shows bearish order flow being maintained. But what happens if we disrespect a fair value gap? Okay, what happens if we inverse a fair value gap? So let's say we have a move up right here, move down, we fill this fair value gap, and then we move up, we come down, we fill this fair value gap, then we move up, and then we have another fair value gap right here, but then, price closes underneath that fair value gap, pretty much disrespecting this fair value gap right here. Well, because we know fair value gaps are used to identify continuations in uptrends and continuations in downtrends, if we see this price range that is supposed to be respected while within an uptrend get disrespected, what can we start crafting in our heads? What can we start thinking about? Okay, this uptrend might be over. And more often than not, it ends up being over. And that's what actually ends up making a inverse fair value gap. So let's say we have a fair value gap right here and we are within an uptrend. And then price comes down and closes underneath this bullish fair value gap. To me, that is showing that we are disrespecting the bullish order flow, because if bullish order flow wanted to be maintained, it would have just filled this and continued higher. But price didn't do that. So it's disrespecting bullish order flow. So then once we see the inverse fair value gap, then what can we look in the other direction? Just like how we look for liquidity sweep, break of structure, fair value gap. Now we can also look for liquidity sweep and or break of structure or inverse fair value gap. So inverse fair value gaps are essentially equal to break of structure, and me personally, I just use whichever comes first. So within this, we have this bullish fair value gap that gets closed underneath. So now I say, okay, we just broke structure to the downside. Even if we don't close underneath the low, if we inverse a fair value gap that's supposed to be respected to the upside, I'm going to be looking for bearish fair value gaps now to potentially get filled to continue the trend down, because we just disrespected bullish order flow. That's why order flow is so important, and I'll make a video on this later in the future. But that explains inverse fair value gaps. And I think the best way to show you guys this is just to show it to you guys on the chart. Okay, and there was a perfect example that we went over on Thursday. So let's go back to Thursday. The setup is the exact same. So we have a liquidity sweep, and this is the power of fair value gaps because they can go in either direction. We have this bullish fair value gap right here. Yeah, price comes in, but we don't see any buy pressure out of it. And then what happens? This candlestick closes underneath it. So that ends up inversing this fair value gap. So that tells us bullish order flow is now no longer being maintained. So even if we didn't break structure here, which we did, even if we didn't break structure here, if we just saw this fair value gap get disrespected, I would be willing to start looking for a bearish fair value gap to get filled, because I know that this fair value gap should have gotten filled and should have moved price higher. What do we see? Inverse fair value gap. This new bearish fair value gap gets filled, and then price ends up going lower. Something that a lot of people like doing is they like saying, hey, inverse fair value gaps need to be filled. Fuck no, they don't. Inverse fair value gaps do not need to be filled at all. Inverse fair value gaps are one thing. They are not fair value gaps once they have been inverse and once they have been disrespected. How do we know a fair value gap has been disrespected? When we have a gap, whether it's bullish or bearish, and we close either above or below it. So if this is a bullish fair value gap and we see a candle that closes underneath the bullish fair value gap, that has then turned into an inverse fair value gap, and that bullish fair value gap has been disrespected. Same thing to the downside. If we see a bearish fair value gap right here and we see a candle close above it, that bearish fair value gap has now been invalidated, and now that is an inverse fair value gap that is telling us that, hey, price will likely move higher from here. Now, this is a little tip that a lot of people get confused when they're talking and learning about fair value gaps, and something that I feel like I should share with you guys. Let me go to a different example here. A lot of people ask, hey, TJR, when we have a bunch of fair value gaps stacked on top of each other, what do we do? Well, first of all, we want to be able to identify all of them. So we have this fair value gap right here, one, and then we have another one right here. And then let's say we even form another one down here. What happens if we inverse this fair value gap, but we have another one above it? Will we be looking for, boom, reversal from that? No. Within a stack of fair value gaps, in order for me to classify it as an inverse fair value gap, so we have one gap here, another gap here, all stacked up, right? And I need to show you guys an example of this where it doesn't apply, but essentially We have one gap here, and then the very next 3 candle pattern, another gap here. For me to be able to say, okay, price has inversed these gaps, and I'm looking to classify this as a break of structure, and I'm looking for price to move to the upside, we have to understand if we close above this, price still can be maintaining bullish order flow because it could just fill this and then move lower. It could just be looking to fill this fair value gap and then move lower, right? So when I'm looking to look for an inverse fair value gap, if there's multiple stacked on top of each other like this, I need the top one, or in the bullish scenario, I need the bottom one to be inversed. So let me find a bullish scenario of this example. Same thing here. So like, look, we have this bearish fair value gap. Just because we closed above it right here doesn't matter, because we have all of these fair value gaps just stacked on top of each other, on top of each other, on top of each other. And the only time that we end up getting a real true inverse fair value gap is when this very top one gets inverse off of this candlestick right here. So yes, this one gets inverse. Yes, this one gets inverse. But since all of these are stacked up on top of each other, without a retrace in between, that's a huge emphasis on that. Without a retrace in between, we have to wait for this one. Okay? We have to wait for this one to get inverse. And at that point, we might as well just look for a break of structure. And we ended up breaking structure right here. Okay, so let me find an example of the bullish scenario of this. Let's look for a bunch of bullish fair value gaps. Okay, so this is a good example. We have this bullish fair value gap right here. We see that price closed underneath it, but what was it trying to do? Do we instantly want to look for shorts off of that? No, because we have another bullish fair value gap right here that price was actually looking to fill before wanting to move higher. So that's why we always need to be looking at the last fair value gap within the stack. And actually this one would be the last fair value gap within the stack. Okay. Let me give you guys another example and another tip that is super important for fair value gaps. I know this video is long, but it's super helpful. Next thing that we need to know about fair value gaps, okay? We need to know about balanced price action and where price has been balanced, and understanding what fair value gaps are going to get filled versus which ones are not going to get filled and which ones we can disregard. This is super important, so stick with me. Whenever we are in an uptrend or a downtrend, once we get a retrace, and then let me just draw this out. So if we're in an uptrend, right? And we see price retrace into a fair value gap, fill it, and then move past this high, we have balanced all price action from this low and under now. All price action from this low and underneath is fully balanced out. So we do not care about a order block down here. We do not care about a fair value gap down here. We do not care about a breaker block down here, because price has already pushed past this high and continued the uptrend. Following that, when price comes down, if we have a fair value gap right here and it gets filled, and then we push past this high, even if we have a fair value gap right here that did not get filled, because we pushed past this high and we continued the uptrend, all price underneath this low has been balanced out. So we no longer care about this fair value gap. We no longer care about the other fair value gaps that are down here. We don't care about anything from price underneath this within this uptrend, because we pushed past this high and we've continued the uptrend. So if we push up and then we have a fair value gap here and then a fair value gap here, let's say we push down past this fair value gap and then end up filling this fair value gap and then pushing up past this high. Now, even if we have a fair value gap here, we don't care about it. We only care about price from here and above now once we push past this high. Same thing in a downtrend, and I'm going to show you guys this on the chart and you guys will understand it a little bit better. Downtrend, so let's say, boom, we break structure, we fill a fair value gap right here. Let's say we have another fair value gap up here, but it doesn't matter, this fair value gap gets filled. We no longer care about this fair value gap that didn't get filled. Why? Because we took out this low and we're continuing the downtrend. Okay, so we fill this fair value gap, we push past this low, we no longer care about anything, any confluences above this high. Price comes down. Let's say there's a little fair value gap right here and there's like 3 more fair value gaps all up here. We fill this fair value gap and then we push past this low. We no longer care about any of these fair value gaps up here. Why? Because we pushed past this low and we continued the downtrend. Okay, let me show you guys this on the chart now so you guys can get a better picture and better idea of this. Let me go to that. What was it? It was Wednesday. This one, yeah. Okay, cool. So I mean, this, whatever, but we can understand the point of this. So again, we see the liquidity sweep, we see the break of structure, we have this fair value gap, it gets filled. And then after this fair value gap gets filled, I know we can't see the high, but on like the 1 minute, we push past this high here. Once this fair value gap gets filled, we no longer care. We have this order block right here. Even though it got filled, we don't care about it anymore. We have this breaker block that got filled. We don't care about it anymore. Everything from this low and underneath, we no longer care about those confluences. Now, this is like mainly applicable for like a bunch of fair value gaps stacked on top of each other. So I just want to find a good example of that so I can show this well. Let me use this stack of fair value gaps for an example. So we have this fair value gap right here, and then this fair value gap right here. So we have two fair value gaps stacked up on top of each other. Let's say price opens on Sunday, and we come up, we fill this imbalance, and then we come down and we take out this low. Now, even though there is this gap up here, we no longer care about it. Why? Because we have continued the downtrend. We have filled an imbalance and we have pushed past this low. So now the only confluences that we're looking for, if we see price retracing, we should never be thinking, okay, we're going to come up and fill this fair value gap. No, fuck no. We're going to be looking for confluences within this leg down. Why? Because this leg down is the one that took out this low, and now we're looking, because think about it. Think about how trends work. They move up, they fill a confluence, and then they move down. And once they take out a low, they're going to move up again. And they never push past these highs, or else that will be a break of structure, and then the trend will change, right? So we're now only going to be looking for confluences within here, whether there's like multiple fair value gaps within here, cool. We see a fair value gap, it gets filled, then we push underneath this low. Now we don't care about if there's a fair value gap up here, there's an order block, breaker block. We don't care about it because we filled this fair value gap and then we took out this low and we continued the downtrend. Now, the reason why I brought this up is not only for fair value gaps, but also for inverse fair value gaps. So if we come through, we fill this fair value gap, this bearish fair value gap, and then we come down and we take out this low. Now we have this bearish fair value gap right here, or let's just say we form a bearish fair value gap right here, a bearish fair value gap right here. If we're looking for a bearish fair value gap and we haven't made a retracement yet, which fair value gap are we going to have to wait for in order for us to inverse this downtrend or get an inverse fair value gap? Are we going to have to wait for this one? No. Now, I know what you're probably saying. I thought you said if it's stacked up. Yes, if it's stacked up within the same leg down. So when we get a retrace, it pretty much resets the fair value gap cycle. So we come up, we fill this fair value gap, then we get a move down. Now we have two fair value gaps. So in order for me to see an inverse fair value gap, or for me to inverse and look for a trend reversal, I'm going to need to see this fair value gap to get inversed. Why? Because we haven't made a retracement yet, okay? But I don't need to wait for this one. I just need to wait for the top one within this leg down. Now let's say we come up, we fill in this imbalance, and then boom, we push past this leg. And then we form another imbalance right here, and there's only one. Which fair value gap am I going to have to wait for me to see an inverse fair value gap for me to want to look for longs, or for me to want to look for now a bullish fair value gap to take longs to the upside? Am I going to have to wait for this one because it's stacked up? No. Why? Because we already filled a fair value gap and then moved past a new low. So now we already have a new leg down that we're considering. So if we inverse this, I'm not going to have to wait for this fair value gap to get inverse. I'm not going to have to wait for this fair value gap to get inverse. Why? Because price from this move up and then down, everything above this high has already been balanced out. Even though there's this fair value gap here, we no longer care about it. Then from here, even though we have this fair value gap here, everything from this high and above has been balanced out. So we no longer care about that. But everything from this high and below hasn't been balanced out yet. So we do care about these fair value gaps. So if we end up inversing this, then we do care about it and say, okay, order flow is probably going to change to the upside. Then from there, we can look for bullish fair value gaps to get filled to then look for longs. Let me show you guys an example of this on the chart. And again, if this is confusing, I completely understand, but I'm really trying to put this shit together for you guys. We're going really deep into this, and hopefully this is starting to make sense for you. So let's show an example let's show the inverse fair value gap example. Okay, this is a perfect example. Actually, no, it's not, because the fair value gap wasn't filled. Okay, this is like a semi-example, but there's not an inverse fair value gap, but if this makes sense to you guys. So within this 5-minute trend down, we're in a downtrend, right? We end up taking out this low. Then we get a retracement. Yes, we don't fill these fair value gaps, but what do we end up doing? Even though we didn't fill these fair value gaps that are stacked on top of each other, what do we end up doing? This was the new low that was formed. We get a little retrace up, and then boom, we take out this new low. So now we don't care about these fair value gaps that are above this high. Why? Because price already moved up and then took out this low, continuing the downtrend. So now, even though there's no confluences within here to be able to push price down further, price from this high and above, we don't care about it. We're not looking for price to retrace into these fair value gaps, then continue down. Why? Because we already retraced and then we already took out this low, showing that this downtrend should continue. So when we get this break of structure to the upside on this candlestick right here, some people might be like, well, we still have this bearish fair value gap. We might be able to go lower. No, because we already broke structure to the upside and we already established that everything above this high we no longer care about. Why? Because it took out this low on the downtrend. So this inverse fair value gap, this fair value gap we don't care about. This fair value gap we don't care about. We only care about the break of structure. Then literally, oh, it's right in front of your faces. We get a break of structure. Then what? Boom, bullish fair value gap right here. Sorry, I'm spazzing. Bullish fair value gap right here. It fills, boom, price, bull run, fucking bitches. It goes higher. Yes. Are you seeing it now? Hopefully you are. Let me find a better example of this so we can try and put this together. I want to find a good example of like imbalances. Okay, this is another good example. Unfortunately, there's no inverse fair value gap, but look here. Okay, so we're within an uptrend. This is at a random ass time. Okay, so again, we don't have all of our confluences. We don't have like liquidity sweep, breaker structure, whatever. But I just want to show you guys this for context. We have a bullish fair value gap right here. We have a bullish fair value gap right here. Price comes down, fills this bullish fair value gap, and then what does it do? It continues the uptrend by taking out this high. So now we no longer care about this bullish fair value gap. Why? Because we already showed and confirmed that everything from this low and below we shouldn't care about because it filled this fair value gap and then ended up continuing the trend by taking out this high. Cool. So when price ends up breaking 5-minute structure right here to the downside, we shouldn't be worried about this fair value gap right here needing or getting filled to then move up higher. Why? Because we already established that this move down and then up balanced out price action from here and everything below it. Okay, now obviously we don't know the overall trend, we don't know the overall bias, so this is kind of taken out of context, but that's another good example. I really want to find an example with an inverse fair value gap. Oh, this is, yes, I finally found one. Okay. So again, this is at a random time. It's during London session, but this is like the one example that I was able to find. So currently right here on the 5-minute time frame, we're within a downtrend, right? Obviously we're going to want to wait for like liquidity sweep, breaker structure, and at the right time during New York session, all of these things, but let's just use this example here. So we know that price came up and it filled this fair value gap and then moved down and took out this low. And on top of that, we also have fair value gaps right here. We also have a fair value gap up here. Okay, this fair value gap and this fair value gap, they haven't been filled yet. But after, we'll start it from all the way up here. We come down, then we get a retracement up and we don't even fill this fair value gap. Why can we disregard it? Or when can we disregard it? Once we take out this low and continue the downtrend. Once we take out this low, we can say everything from this high and above, we don't care about those confluences anymore. Why? Because we continued the downtrend underneath this low. So now we know we can literally remove this fair value gap. We should never think about it again. Literally never think about it again because it's only applicable within this downtrend. In this downtrend, we showed that, hey, we balance out price action and now we're continuing it. So we shouldn't care about this. It should no longer be marked out. We can fully forget it. Then following that, on this leg down, we have boom, fair value gap here, fair value gap here. We see price form a low right here. We push up, we only fill this fair value gap, and then what happens? We continue the downtrend by taking out this low. So what do? We no longer care about this fair value gap, and we no longer care about any confluences from this high and higher. So we don't care about this fair value gap, we don't care about this fair value gap, we don't care about any of those. Now, what fair value gaps are we considering? We're not even considering this one anymore because it's been filled. Price action has been balanced because we took out this low. Now we are going to see the power of an inverse fair value gap that happens before a break of structure. Finally, I was able to find an example. Because we took out this low, we have this bearish imbalance. We are expecting price to fill this bearish imbalance and then move lower. And we know that if price pushes past this bearish imbalance and disrespects it, there's no other confluences that we're looking to consider up here. Why? Because prior to that, price has already balanced out those legs. Why? Because it took out those lows. So we don't care about this fair value gap because price, even if price is moving up, it's not gonna do anything off of that. It's going to be off of a different confluence on a different time frame. We don't care about that anymore. So once we see this candle disrespect this fair value gap, awesome. That's when we could say, boom, the trend has changed. We're going to end up moving higher. Now, obviously, and unfortunately, in this example, this is at a random ass time during like going into London session, coming into New York session. So price is going to be moving weird, but using this at the right time and in the right place is just, it works like a freaking charm. Let's see here. I think this might actually be a good example too. Okay, this is perfect. This is another example. Within this leg up, what are we in? We're in an uptrend. And since we know we've retraced down and then we took out this high, we can disregard every single confluence that's under this low, right? Luckily, there's not really any confluences underneath this low. But we're only considering the fair value gaps within this extension up now, or the confluences within this extension up. So what do we have? We have a fair value gap right here. And then we also have a fair value gap right here. The tiniest one. But again, size doesn't matter. On this down candle right here, we end up breaking structure too, but just for example purposes, this down candle right here, what do we get? We inverse both these fair value gaps. So boom, we know that we should be looking for shorts now. Then following that, what does price do? It comes up and it fills in this bearish fair value gap and then ends up continuing lower. Boom, price ends up rumbling on down, taking out this draw on liquidity. So to recap, fair value gaps are imbalanced price action that are used as continuation confluences within uptrends and downtrends. Inverse fair value gaps are used as confirmation confluences that we are confirming that price is disrespecting current order flow and will more than likely reverse the current trend that we are in. And again, there's a reason why it's fair value gaps and inverse fair value gaps. Fair value gaps are showing us that, hey, we are continuing the trend. Inverse fair value gaps are showing us that, hey, we are going against the trend, okay? And we're probably going to reverse. Hopefully you guys learned a lot from this video. Hopefully you guys can take this and apply this within your own trading. I know this was a long video, but hey man, I had to get all this shit off my chest. Hopefully you guys learned more about order flow. Hopefully you guys learned more about fair value gaps and inverse fair value gaps, when to use them, when to not use them, which ones you guys can learn to identify and which ones not to. I appreciate you guys. I'll catch you guys in the next one. Peace out.